technical stuff. Maybe it'll work. We did just do a practice run, but that's no guarantee of pretty much anything. Great, there's a picture of me in my hat. All right, so theoretically, Jared's going to go in here. He'll be able to hear us on the microphone. Great, there's a picture of me in my hat. All right, so theoretically, Jared's going to go in here. He'll be able to hear us on the microphone. Great, there's a picture of me in my hat.
Hey there, can you hear me?
Yes. How about everybody else?
Yeah.
Okay. Yeah.
Okay.
Can you hear us back?
I can, yeah. Let me open up my slides.
Tweet or email any of those people that you're talking to. Okay, cool. Sweet. Okay, theoretically it will work. So Jared, I might just put you back on the phone and on speakerphone just in case anything cuts out. We'll be able to hear you through that. Does that sound all right?
Okay.
Here comes that again too.
Okay, can you hear me?
We're good.
Okay.
Okay, so
Let me see if I can show my slides now.
nice. So Jared's been a VIX. He's studied the VIX and various volatility products for what, probably like 6 or 7 years. He started while you were in grad school and already had a newsletter where you were starting to get all these clients just listening to you. You're doing a philosophy PhD and decided that might not be the best way to make money. And somehow you were also thinking about volatility at the same time as metaphysics. And then he's a super clear writer and speaker because of all the liberal arts just training your mind and sharpening it to this fine point. Every time he says something, it's like a train that just like barrels through your any sort of counter argument you could make, or it's impossible to misunderstand him also, which is great in a really technical field. There's always different ways to measure volatility, and there's all kinds of geeky stuff you can get lost on. And Jared's really good at sticking to the high-level details, which is why he's a strategist and doing stuff at BGC.
Oh, I lost you. Hello?
Okay, Jared, I was just complimenting you for a while, but
Okay.
you know who you are.
Okay. Thank you. Yeah, I don't know how I could possibly follow all that introduction, but let me, so you guys can see the slides, yeah?
Yep, we're good.
Okay. So I've got about, I don't know, I could go like 15, 20 minutes on this stuff, but I don't want to go too long because I'm just interested in the questions people have or anything that that any of this stuff kind of sparks in terms of your interest or ideas. So so yeah, talking about alpha decay as just a fancy name for what happens when strategies that used to work stop working. When they lose their edge, which is this, if you know that song from LCD Sound System, it's this kind of feeling of being replaced or superseded, and this happens to every strategy, it happens to every portfolio manager, every trader, I think, at some point, and you have to adapt. So one thing that got me interested in maybe thinking about talking about this idea, article a couple months ago in Bloomberg talking about some guys who were out in the desert, using some, quantitative tools to develop strategies and to trade, and which is not the first time we've heard about things like this. I think the commodification of quantitative strategy has been in place for a long time, and it just continues. One effect of that is that I think that as more people enter the market, as more people approach idea generation and strategy development, some things that used to work stop working, or they don't work in the same way. And so that presents some interesting challenges for the rest of us who've been in the markets for a little bit longer. My main idea is that when a trading strategy works, it only works because there's some fundamental economic reason that it works. It could be that you're transferring risk from someone who doesn't want that particular specific type of risk to someone who can bear it, which is historically, for instance, the role of banks. It may be that regulation or different maturity preferences and risk preferences justify some kind of a trading strategy. But if the economics underlying the strategy change, then the strategy stops working and performance decays. The thing that's been on my mind for quite a while now is the fact that if you can't explain why a strategy works in very clear human terms, then it's very difficult to know what the difference is between some kind of an ordinary dip or some kind of a momentary lapse versus a fundamental change that signals that the strategy is kind of dead. And that having some, so the conclusion, just to give it all away here at the beginning, is that I draw is that being able to understand in very plain and simple and boring terms, like why your strategy works, what makes it work economically, is, I think, absolutely essential. No matter how quantitative you are, how rigorous your testing may be, understanding what about the world causes a strategy to be profitable is just as essential as ever. So the agenda for a few minutes, we're going to look at some dead strategies or things that stopped working. Some interesting ways that these strategies fail, apart from the traditional, problems of backtesting and things like that you might be familiar with. And then a few comments at the end about ways that the industry and people are adapting to this kind of challenge. So one of the maybe most classic examples of a dead strategy is portfolio insurance, something that came around in the early 1980s. Some academics, Leland and Rubenstein, came up with this idea of essentially helping equity and fixed income investors perform dynamic hedging on their portfolios. So instead of buying and selling bits of the stuff that they owned, they would buy and sell index futures, equity index futures or bond futures, to essentially replicate the payoff of a put option, but just using cash and the futures contract, which you can really do. And one of my favorite articles of all time in finance is actually by these two guys, and it just illustrates the way that you can replicate. I think they do it with a call option. How you can replicate the payoff of a call just using the underlying asset and cash and like T-bills. Which, when you break it down into the very simple components, is, I think, very enlightening. But when they tried to implement this in the real world, they essentially became a little bit too successful, reportedly managing or covering $30 billion in assets with their strategy before the '87 crash. And then, oh, sorry?
You guys do it. So just something went on with the sound here. We might have lost you. You might have lost us.
I can hear you.
On the phone, right?
Yeah.
Okay. Well, I'll leave that okay. Sorry, guys.
So we okay?
What?
Okay. Can you hear me?
I'm good. Hold on.
Okay.
That's it before. Something different than something we'll find with so I've got a couple backups, but not enough. Okay, that's good. Yeah. Well, that's it. How many people can hear the phone? Really? Okay. the louder one? Okay. Sure, that's fine. What do you mean by that?
Hey, it's Jared. Hi. Testing 1, 2, 3. Okay. Sorry, I can't really hear you guys that well. Oh, no slides? Okay. Um, okay. Okay, so you want me to just continue off the slides? Okay. Okay, no problem. Okay. All right. Hey, good, good. Okay. Yeah, I think so. If nothing else, like being able to be confident about the order flow that you're interacting with. So if you're trading, at that speed, my understanding is there's quite a lot of time and energy spent developing algorithms that get you in a position to take advantage of, let's not say uninformed or like dumb order flow, but just order flow that's indifferent to price. Like there's plenty of actors in the market, maybe a mutual fund manager or something like that, who is not all that sensitive to price at the very fine scale. And so being able to trade, with those people is kind of essential for some strategies. If those folks, right? Yeah, I mean, I guess you could trust it or trust but verify. I would still say that some of the things that I'll get to in a second that can kind of come out of nowhere and ruin a strategy would still be in play, even in that situation. Things like regulatory change or technological change or something fundamentally different happening in the world that affects who's interacting in the market. Just who the players are in the game could still cause. I mean, especially if you're in a product that's relatively new, or with a strategy that is relatively new. What's that? I didn't catch the first part. Yeah, I think that would be a good example.